Hello there. Today I'm going to be presenting on my investment strategy, which consists of picking well-known companies that have a low price to earnings ratio that hopefully have a more favorable risk return trade-off than that of stocks with high price to earnings and the market in general. To find companies whose stock prices the strategy is to find companies with stock prices do not necessarily reflect their fundamental worth that will potentially be priced higher in the future to reflect their true value, which allows for investors to make a capital gain. The reasons for the stocks being undervalued in the market can vary. Um, to test this strategy, I've analyzed data over the past decade, starting from May 1st of 2005 to May 1st of 2015. And compared average annual return and risk among different portfolios. I've constructed three different portfolios. Portfolio A with with stocks that consist of low price to earnings ratio between 0 to 15, while portfolio B consists of stocks with high price to earnings ratio that are above 25, and portfolio C that consists of stocks with average price to earnings ratio between 15 to 25, depending on what kind of industry they're in. And the price to earnings ratio is based on the figures from May 1st of 2005 to test out the strategy to see if an investor invested their into a portfolio in 2005 with stocks that have low price to earnings ratio to see how that portfolio with low price to earnings ratio would fare against portfolio of stocks with higher price to earnings ratio and portfolio stocks with average price to earnings ratio. As you can see, the companies that consist or make up the low price to earnings ratio include Verizon Wireless, AT&T, Target, ExxonMobil. The portfolio with high price to earnings stocks include JP Morgan Chase, Electronic Arts, Netflix, Starbucks, Yahoo, among others, and the portfolio with average price to earnings ratio as of May 1st of 2005 include FedEx, Walmart, Costco, Oracle, Coca-Cola, UPS, Microsoft, among others. Over analyzing the data over the past decade, it seems that portfolio A has an average annual return of 14.78% with a standard deviation of 0.191. Portfolio B with high price to earnings stocks had an average annual return of 15.42%, which is higher than that of portfolio A. However, it does also bear a greater risk. Portfolio C has a lower and average annual return than both portfolio A and portfolio B. However, it does also have the lowest risk among the three. As for our benchmark index S&P 500, it has the lowest average annual return of compared to all the three portfolios. However, it does have a lower risk to that than that of compared to portfolio A and portfolio B. However, it seems that portfolio C, with an average annual return of 11.76%, does have a higher return than that of S&P 500, while still having a lower risk in the past decade. As can be seen on the graph, the annual returns from both low PE stocks and high PE stocks fluctuate quite a bit, while the return from portfolio with average price to earnings ratio and S&P 500 index have a more stable returns. The portfolio with average price to earnings stocks in particular yielded positive returns across the board except for in May 2009 due to the recession the year before, and is the portfolio that has shown the most stability in the last decade. The t-test between low PE stocks and high PE stocks showed that there was no statistically significant difference in returns if one were to invest in either of these two portfolios, as the t-stat falls within the range of the null hypothesis, as the null hypothesis cannot be rejected. There exists no difference or no statistically significant difference if one were to invest in either low PE stocks or high PE stocks. As it is clear, the t-stat does fall within the T critical two-tail values. Similarly, the low PE stock portfolio compared to average PE stocks portfolio, a t-test conducted with two samples assuming unequal variances again yielded the same result, in that the t-stat does fall between the values of the T critical two-tail, meaning that the null hypothesis again cannot be rejected, and there is no statistically significant difference in investing between either low PE stock portfolio or average PE stock portfolio over the past decade. This is highlighted further in the graph shown. The graph shows the risk-return trade-offs for each of the portfolios. As can be seen in the figure, the portfolios offer different risk-return combinations, and the choice of which portfolio to pick is based on individual risk tolerance, as none of the portfolios are evidently better than the other. However, each of the portfolios tend to lie closer to the efficient frontier than the S&P 500 index. The efficient frontier should be somewhere along this line, somewhere around here. And as can be seen, the portfolios do lie closer to the efficient frontier than the S&P 500, reinforcing the statement that one can earn a higher return while reducing their portfolio risk if they own a well-diversified portfolio, as compared to investing in an index fund. Also, since these portfolios only contain 10 securities, the risk or variance of returns can be reduced further down by adding 10 or more securities to the portfolio. To conclude, the portfolios picked due to low PE stocks low PE stocks ratio do not outperform portfolio with higher or average PE stock as concluded by the historical analysis. The choice of which portfolio to pick or to invest in boils down to risk preference. However, it does seem that the average price to earnings stocks offer more stable returns than stocks with price to earnings ratio at either extremes, be it low or high. Hence, it can be good for investors that are more conservative and that would like to bear the least amount of risk. However, in general, there is no clear winner as to investing based on price to earnings ratio. And ultimately it does boil down to individual risk, preference, and tolerance. Thank you.